Hi everyone, with this video we are getting solved with the flow company question. This is the very first section C case study from your PM pre-December 2025 mock exam. Now this is a question which the ACCA has chosen to repeat from one of the pre-mocks that they have released earlier. So if I let you people know, this is the same question that they had published in the PM pre-March 24 mock exam. So rather than wasting time and recording that video again, I am uploading the video that I have uploaded as a part of the pre-March 24 debrief which I did earlier. So the question is absolutely the same. So you will be seeing the video shortly where I am solving, debriefing the flow company question with you. At the top, you might be seeing that the pre-March 24 mock exam is written at the top. So this is not the same question. Please do not think so. This is exactly the same question because the ACCA has chosen to pick up the same question which they published in pre-March 2024 mock exam. So watch the video, and I really hope that this video is going to help you people to be able to practice better for your final exam. All the very best.
This question is called flow company, and as you can see with like the first glance upon the question itself, that it pertains to ROI and RI approach of measuring the performance of the projects, investment appraisal also you can say. So this is how we are getting into the question. Let's read the requirements first and then we'll move on to reading the scenario. So the first requirement wants me to find out the return on investment ROI for each division and state whether or not each manager reached their target. So basically we are in the process that the investments have already been made and we are evaluating the performance of these managers. We are seeing whether or not they have reached their targets. This is a 6-marker requirement. Requirement B wants me to find out the residual income and briefly comment on the performance. So both of the requirements have comments as a requirement under each of them separately. Now let's read the scenario. Flow Company is a large manufacturing company specializing in the manufacture of a wide range of pumps. The company has 2 divisions, commercial products, division C, and domestic products, which is division D. So I can just prepare like a brief template for my solving also. This is part A where I am finding out the ROI. So basically, there are 2 divisions, division C and division D. So I have briefly, formatted some part of my answer. Each division operates with little intervention from the head office, and divisional managers have the autonomy to make decisions about long term investments. So, this is helpful because this is going to help us find out the controllable profit. Flow Company measures the performance of its divisions using ROI, calculated using controllable profit, and average divisional net assets. The ROI, target ROI for each of the divisions is 15%. If the divisions meet or exceed this target, the managers receive a bonus. Last year, an investment which was expected to meet the target ROI was rejected by one of the divisional managers because it would have reduced the division's overall ROI. Consequently, Flow Company is considering the introduction of a new performance measure, residual income, in order to discourage this dysfunctional behavior in the future. Like ROI, this would be calculated using controllable profit and average divisional net assets. The draft operating statement for the year prepared by the company's trainee accountant is shown below. So these are the divisions, these are the values that we have, and there are some notes attached. So the first note says included in the fixed costs are depreciation costs. So these are the fixed costs. Depreciation costs of 520,000 and 180,000 for C and D respectively. 40% of the depreciation costs in each division relate to assets controlled but not owned by the head office. So these are the assets which are controlled by the head office. Head office recharges all of its costs to the 2 divisions. These have been included in the fixed costs and amount to 750 and 590 respectively. So basically these are the costs over which the managers have no control. So that is why this is something which will not be their controllable profit. So Division C invested $4 million in plant and machinery at the beginning of the year, which is included in the net assets figure above, and uses the reducing balance method to depreciate the assets. Division D, which uses the straight line method, made no significant additions to non-current assets. It is the policy of both divisions to charge a full year's depreciation in the year of acquisition. Flow Company has a cost of capital of 12%. So with this, we have briefly gone over the scenario. Now let's go on to answering the question. So the first thing which we need to find out the ROI is the controllable profit. So first of all, I have to work out the controllable profit. So the profit, what's going to be my starting point? The profit that is given as per the P&L. So this is the profit which is given to me as per the P&L. So for division C, the net profit is 3990 and division D it's 1125. So these are basically the profits which are given. Now basically, the part of depreciation which relates to the assets which are controlled by head office is something which should not be my cost. So this should be added back. So I am adding back the head office depreciation. So I have been told that for this department, this specific department C, 520,000 is the total cost of depreciation. And out of this, 40% is something which is not controllable by these people. So again, please be very careful that over here we are working in 3 zeros. So I will not be putting these 3 zeros. So 208 is something which will be added back. Now similarly for this division D, division D has 180,000, 180 multiplied by 40% is something which will be added back. Now there was one more thing which I need to add back, which are the costs, the fixed cost, the head office recharges. This is something which is not in the control of my managers. So that is why this is going to be added back. So head office recharge gets added back. For division C, it is 750 and for division D, it is 590. So I'm adding back these both. Now with this, I arrive at my controllable profit. So my controllable profit is going to be the sum of these three. So I can simply apply the sum formula, drag it from here to here and arrive at my controllable profit. Now the next thing which I'm supposed to find out, the next thing which I need for my ROI is my average net assets. So when I talk about the net assets, I need to, account for these things to find out my net assets. First of all, it's okay, these are already given. So opening and closing are given. So I can simply take an average of this 36,000 divided by 36 plus opening plus closing divided by 2. So this is going to give me my average net assets. Similarly, using the same technique, 10 plus 12 divided by 2 is going to give me my net assets, average net assets for division D. Now I have both of the things to find out the ROI. ROI is basically, the formula was also given over here, that we find out the ROI using controllable profit and the average net assets. So this is my controllable profit and these are my average net assets. So basically what is going to be present over here in your numerator is going to be 4948 and this is in terms of thousands. And again, when it comes to the divisional assets which have been provided, these are also in terms of thousands. So I have made a mistake over here. This should be in terms of thousands only. 33,000. And again, here also I will need to add the zeros. So these are my average net assets. With this, I need to find out my ROI. My ROI is going to be my controllable profit divided by my average net assets. Similarly, copy pasting the formula to the other division also, I arrive, changing the format to percentages, I will arrive at the percentage ROI for each of the respective departments. Now we can also say, has the target been met? Target been met. So 15% was the target. So this division has not met the target, and this division has met the target. Now, this requirement you would think is finished, but it's not. We have to state whether each of the managers have met their target. So, even though we have mentioned over here, it will be good that you put it in words that division C has not been able to meet the ROI target of 15%. However, division D has has achieved an ROI above the target ROI. So now we are finished with this part. Now we will move to part B, where we find out the residual income, and again we have to comment on that also. So part B is about residual income. Again, I can just copy paste the names of the two departments from above. So over here I'll solve for these, and the requirement is to find out the residual income. So the first thing that I need to find out the residual income, basically I have my controllable profit from above. So I can just copy paste those values over here. This is my controllable profit for the respective divisions, right? So this formula might not work. So I can just equals to this, and over here also equals to this. So with this, I have my controllable profits. Now, basically, the finance cost, the cost of capital is also provided to us. So if I just find out what's going to be the cost of capital on the average net assets, so I'm just going to take cost of capital on average net assets. So basically, I have my average net assets right here, and the cost of capital is also given to me as 12% right over here. This is given here. So I'm just hit enter, and this is what I have as the cost of capital, which is levied on my assets. Now, what is going to be my residual income? My residual income is going to be the difference between the profit and the cost. So this is what the residual income is going to be. Similar can be copy pasted to the division D also. Now over here also the question is not complete yet. We have to briefly comment on their performance also. So we can comment over here that using the residual income method, both of the divisions, you can see both of these divisions are giving us positive figures. So the managers will be given bonuses. The cost of capital of this company is, if you see that the target ROI was 15%, but the cost of capital is only 12%. So because of the fact that your cost of capital is lower than the target ROI, this is giving you more favorable results over here, a higher positive value over here as your residual income. Now we are done with part A and B. I have just explained what the statement over here will be, but please be sure to type it out when you are practicing or writing your exam. Now let's come to part C. Part C is, you can say, a theoretical requirement, something which is discursive, does not involve numbers. Discuss the performance of the two divisions for the year, including the main reasons why their ROI results differ from each other. Explain the impact of the difference in ROI could have on the behavior of the manager of the worst performing division. So basically, if we go back to our calculations, to formulate what we are going to tell about the analysis. So first of all, if you see, division D is the division which has exceeded the target ROI, but division D has not. So if the controllable profit in relation to the revenue is something that we are comparing, division C's margin is 59%, and you compare that to a margin of division E as 56%. So division C is actually performing slightly better in terms of the profitability. So division C, if you see, has a higher asset base also. They are having significantly higher assets than division D. So that is also something which will lead them to have a lower ROI, because the denominator over here in ROI is your average net assets. So because the denominator is so high, that is why they are getting a lower ROI. So if you see, division C appears to be a larger division if we talk about the revenue also. So if you see the revenue over here, division C has a significantly higher revenue with the similar business. So basically, there is a possibility that they can reduce these assets, to basically they can uh, reduce some of the assets so that their ROI also increases. So the fact that there have been additions, with statement 3, we see over here that division C has invested in plant and machinery, and they are using the reducing balance method. So basically, why the fact that they are buying so many assets, they are increasing the denominator. That is why it's also resulting into lesser profits, because depreciation also gets subtracted from your profits, and this is something which they are buying on their own, they have control over, so it subtracts from their controllable profit. Now we see that division C is also using the reducing balance method. So whenever the reducing balance method is used, basically we are charging more and more depreciation in the early years, but when it comes to division D, they are using a straight line method. It's mentioned that they are using a straight line method. So whenever straight line method is used, that means same amount of depreciation in all of the years. This is also some factor which could have led to the differences in their ROI. So if we also compare the ROI results, the manager of division D will only get the bonus and C will not. So there is a possibility that the divisional manager of division C may get demotivated, and he will not be making future investments even if that's good for the business. So this is something which should be considered, and the performance measure should be changed accordingly. This is how we have answered requirement number C. Now we move on to the last requirement for this question, which talks about, wants us to explain the advantages and disadvantages of using RI approach. So the theoretical questions which are being asked in this case study are pretty normal, are pretty, standard. If we say, these are some requirements which you would ideally expect to come in your exam. So please prepare these requirements well. This is a 4 marker question. You can either write 2 each, or 3 advantages, 1 disadvantage, but it will be better that you weigh your answer equally. You are putting both of the points equally. So if we talk about the advantages first, basically, so whenever we are talking about this part, we will be also trying to link it to the scenario, because that is how it's going to be useful, and the examiner knows that we have not just learnt the answers, but we know the concepts. So if we talk about the advantages of using RI in this case, the use of RI will basically encourage the managers to make new investments, because they will not no longer be worried about the denominator of their ROI. So a new investment idea will basically add to the residual income, because it's going to give you more profits, but it's going to reduce your ROI, because that's the denominator of your ROI. So in such a situation, measuring performance with RI will not give you a dysfunctional behavior. So the heading of disadvantage can be dysfunctional behavior. No dysfunctional behavior if you are using RI. So if they are at flow company using RI, this will lead to decisions which are in the best interests of the company. Talking about another advantage, so when you use RI, you can also use different costs of capital. So, which we used earlier, 12%, we could also use it at 15%, 20%, whatever we want. So this gives you, different information and this will help you to make good decisions also. So this is another advantage which you can say. One more advantage which you have is that since the imputed interest charge is deducted from profits, so the managers will be more aware of the cost of assets. So they will not spend money unnecessarily because the cost of capital will be subtracted at the percentage of the assets that they have. So, they will be taking care that they are only buying those assets which are actually useful for the business and which will actually improve the profits. Now, these are the advantages. Now, talking about the disadvantages. So, if I talk about the first thing, it does not facilitate comparisons between the divisions because it is not, the RI basically is taking into account, the absolute figure. So, if we talk about flow company itself, the residual income, which we just calculated, the residual income of division C is, you can say, nearly double of division D. So in such a scenario, division C would come out to be a larger division. So this comparison is not taking into account the sizes of the divisions and their investments. So this is one of the disadvantages, that you cannot compare between the divisions. Another disadvantage is that the RI method is based on accounting measures of profit and capital employed, which can also be manipulated. So there is a possibility that, the managers are going to use different sorts of ways to manipulate the things, because accounting terms are something which are in their hands. So they might try to, window dress the accounts in order to maximize the bonuses that they get. So this can also lead to manipulations by the managers, and this is a limitation because residual income is based on accounting measures. So this is also a common problem that RI shares with the ROI approach. With this, we have answered all of the requirements which pertain to flow company. I hope that this was helpful. All the very best for your exams.